Hello and welcome to this video module on discounted cash flow analysis, part 2 of 2. In this video, we're going to put the theory that we learned in the previous module into practice in the form of our Excel model. If you open up the attached Excel model, Makeup Co. Financials, the valuations, you'll see we still have our Assumptions tab, Income Statement, Balance Sheet, Cash Flow Statement, so we've got our forecast model, the debt schedule that was part of that, also the previously reviewed comparable companies analysis and precedent transactions analysis. You'll also see a DCF tab, and in this tab I have set up a basic discounted cash flow analysis template. So let's focus on the cells with the green highlight, and we'll start adding some figures here. So first thing we're going to focus on is the cost of equity. We're going to do cost of equity, cost of debt, which is going to lead us over to the WACC. As you recall from the previous module, cost of equity based on the CAPM theory, we need a equity risk premium, and that's something that's made available from various financial research databases. I'm going to use 8.4% because that's one I've used before, but a company such as Ibbotson, which is now owned by Morningstar, publishes data and can provide a premium for us. Risk-free rate, I'm going to use a recent value for a 10-year treasury, but you can look those up online. I'm going to use 3.9%. And because our Makeup Co., our target company here, is a private company, I'm going to add a small premium to account for the fact that investors will demand a higher rate of return than they would were they in just a public stock, because private company stock is usually not as liquid. I'm going to add 6% there. The equity beta for the industry, and this is something that's covered well in the textbook. It needs to be unlevered and relevered. I'm just going to add 1.6, which is something that I did by looking. I'm just flipping over to our comps. I looked at the betas, just got those from Yahoo Finance, for our 4 beauty companies, and they actually trade a bit more volatilely than the overall market. So we get a cost of equity of just over 23%. Cost of debt, I'm going to assume that our company has a 12, could borrow from a bank right now at 12%. Quite a high rate, but it is a private company, not the largest company out there, probably not investment grade debt. And its marginal tax rate, we're just going to link back to the assumptions, which was 35%. So we get an after-tax debt. Last thing we need to do to calculate the WACC is just find the optimal capital structure. And another thing I did here, I went back to our comparable companies, and for each looked at the debt as a percent of its total enterprise value. And for those companies, I got 20%, and I'm going to take that as a proxy for the optimal capital structure for a company in the beauty industry. So 20% means we have 80% weighted on equity. So our WACC is just over 20% when it's all blended together. And that, if we trace through, feeds into our discount rate. And I'm skipping the free cash flow section right now. Just look at the present values so we could see that if you follow that formula, it is just linked right up to WACC. And then I've built in a little bit of a buffer, but a bit of a sensitivity around it. So I have 1.5% off and another 1.5% off. So basically a range of 6% around that WACC. And that's going to be repeated a few times throughout this module here. We'll also see it down in the total enterprise value where it's just being presented. Let's go back up to the free cash flow part. Now, as we learned in our module, it's a pretty basic formula for it. It's going to be EBIT less taxes plus D&A less some other cash uses such as working capital and CapEx. So we'll just tie these to values right from the model. EBIT from the income statement there, and we'll copy that across. Taxes, we're just going to tax affect the EBIT, which will be taking that times that from the assumptions page, the tax rate, which I'm going to lock in. So again, and we should make that, let's just make this a negative value, and we'll copy that across. We're going to add back the D&A. I'm going to grab it from the income statement. We don't have any amortization in this model yet, so just depreciation comes in as a positive. Let's go to the change in working capital. That's going to be the sum of a few entries from the cash flow statement. Basically, all these entries having to do with capturing these year-over-year changes in receivables, inventory, prepaids, payables. It's basically working capital is the current assets, current liabilities, excluding cash. So, and again, that one, for a growing company, that one's usually negative. If you're growing, usually means you're going to have an increase in inventory unless you're kind of doing some sort of sell down. You're usually going to have an increase in your receivables and a decrease in payables, but the asset side would usually outweigh the liability side. And lastly, let's grab our CapEx from the cash flow, and that should also come in as a cash use. So, and I've set up these formulas. I'm just going to do a quick bit of formatting here just to keep everything nice. So you can see it's simply a sum. Just so you want to make sure you have your signs correct, that things that are less are coming in as a negative, things as a plus are coming in as positive. So we've got our free cash flow for 3 years. Next thing we need to do, and we're going to focus right in this green cell here, is get the present value of those 3 years. And for that one, since we're using, we're just going to come back 3 years right to the date, it's okay to use our Excel formula. So NPV, and you can see where I get a little guidance up here. So we need the rate, and we'll lock that in as our rate. And our values, it's going to be these 3 right here. And those I'm going to lock in so I can copy my formula. So I'm going to copy that up and down. And you could see that the high, just to reality check, the higher the discount rate, the lower the value. So, meaning an investor expecting a higher return, that present value is lower. Likewise, the lower the discount rate, the higher the present value. Just a couple more big cells, and then we're going to be done. So let's do the terminal value method, and we're going to do a couple things at once in this cell. We're going to calculate the terminal value and calculate the present value at the present value of that terminal value at the same time. So what we're going to do, we know that we need to take our EBITDA multiplied by some sort of exit multiple, and then we need to discount that back to the present day. So let's first grab our EBITDA for year 3, go into the income statement. There it is. Multiplied by our assumed terminal value. And you can see I've got 3 across the top. And then we simply need to discount that back at 1 plus our discount rate raised to the proper number of years. And we're going to bring everything back 3 years. Now, before I copy that cell, that formula, I want to lock a few items on there. So this just makes it easy for us to move across and copy the formula. So I know that cell, the last cell, telling us 3 years, that one's going to be completely locked. Likewise, I know that first cell on the income statement is going to be completely locked. The next one, I want to actually move, as I go from 9 to 10 to 11, I want that to move across in columns, but I want to lock the row 25. Similarly for the discount rate, I want to lock the column, but let the row fluctuate. And that should be it. And we should see that I should get reasonable values moving across. And let's just do a quick reality check. We know that the lowest value should be down the bottom left. It has the lowest exit value and the highest discount rate. Likewise, our highest value will be with the highest terminal value and the lowest discount rate. And I normally kind of focus my attention right around the center. But let's just go through this once again. We have 9, 10, and 11, and I got these from our, basically kind of just approximating from our comparables, where we had 11 and 11 as an EBITDA multiple, and our precedent transactions where we had a 12. So that's why I'm showing a range 9 through 13, kind of focusing on the 11. Let's move over to the perpetual growth method. And again, we're going to try to come up with one formula in this cell here and lock the appropriate cells so that we can just copy it across. So like we did with the EBITDA multiple method, we're going to try to come up with the terminal value and then discount it back all in the same cell. So terminal value is going to be our final year of free cash flow growing by some assumed rate. So 1 plus, and that rate is right there. So that'll give us, basically, that's 1 year of growth on that year 3 one. Now we want to grow that forever. So what we need to do is take a WACC minus the growth rate. And that's basically, that is giving us the actual terminal value. And I just wanted to click return just so you can see that. Now watch this, we're going to discount that back. So we need to do, like we did with the EBITDA multiple method, 1 plus a discount rate raised to the proper number of years, which is 3. So instead of 900 million, we're now down to 600. Let's go through and lock the appropriate cells. Again, we know with this final cell, that one's going to be fully locked, and our initial cell is going to be fully locked. Others are probably going to move. So L25, so our 4%, we want to lock the row but not the column. So I will lock the row. And for this one, the WACC, I want to lock the column but not the row. And then just like we did with the other L25, we're going to lock the 25, the row, not the column. So we will copy this over. And looks like I did something wrong already. I did. Forgot to lock that last one. So we're going to lock the column there. That was a good example to see that you need to make sure you lock your cells properly. And like we did with the EBITDA method, let's just do a quick reality check. The lowest value should be at the lowest perpetual growth rate and the highest WACC. And the highest value should be at the highest growth rate, 8%, and the lowest WACC. Just an item to note here. Well, let's go down bottom. I'm just going to fill out some quick outlining here. Down bottom, where we have the answer, the total enterprise value. These cells are simply set up as the sum of the NPV, the sum of the 3-year NPV and the terminal value. And you could see, for example, let me go on this center one. So that and the center one. Likewise over here, that and that. So this is kind of giving us what I would call the output of the DCF valuation. Now I just want to address the fact that we've got a $1.9 billion valuation from the EBITDA multiple method and a $750 million valuation from the perpetual growth method. The difference, since they both have the same NPV of the free cash flows, the difference is in the terminal values. That is because we're looking at a very high growth company that we're valuing, growing at 20–25% per year. It's really not accurate to use a perpetual growth method and say that a company like that is going to grow at 20% per year. The numbers would just be off the charts, as you can see. So let's, instead of looking at, so I put in 4, 6, and 8, just want to show you how much these values move. If, for example, we looked at 10% perpetual growth, you know, you're already up to $1 billion on your middle. If we looked at 16%, you're already above $2 billion. Again, nobody's really going to trust a perpetual growth of anything really in the double digits. So I'm going to just present this to us so we learn the method. But I'm going to, when I present my valuation to my client, I'm going to say we use the EBITDA multiple method. So what I want to do when we go to our, I'm going to flip over to it, we're going to go to our valuation summary page where we've already put in our range of values for our public comps. We already put in a range of value for M&A comps. And we're now going to put in a range of value for the DCF. I'm going to show from our low end to our high end. So 1.5 billion to 2.4. And the way we do that, as I mentioned in the previous module, this valuation summary is really a horizontal stacked bar. So we have a bar going from 0 to 1.3, and then the next bar spans 400, if you can see with the public comps. So I am going to recall my numbers. So my first part of the bar will be at 1,500, and that is the clear part of the bar. And then the difference between, 1.5 billion and 2.4, so 900. We're going to have quite a wide range here. But there's our DCF now. And this football field presentation would appear in a book, a valuation or a pitch book, something done for a client or a potential client. And what it does is it shows what we might normally expect. We've got M&A comps higher than public comps. DCF, kind of a wide range because we are basing it on a sensitivity analysis. If we flip back to the DCF, we're showing quite a wide range of exit multiples. A 6% swing in our discount rate, so it's perfectly fine to have a range here. What some might do would be in Excel, insert a shape. If a client wants something a little more specific, we might just put a kind of a line in, sort of saying, hey, this is kind of where we see the valuation, and I might go, in this case, kind of something like that. Telling the client that this company is worth, maybe something just around $1.8, $1.9, $2 billion, depending where we'd like to set expectations. That wraps up DCF. And we've previously covered comparable companies and precedent transactions. So we've done a pretty good job covering the main valuation methods used by investment bankers. We're going to go into LBO analysis in future modules. Please join us.